Most people treat health savings accounts like glorified medical piggy banks. Put money in, pay for doctor visits, repeat. What they don't realize is that the wealthiest investors view HSAs as something completely different. The single most tax-advantaged retirement vehicle in the American tax code. And they're maxing these accounts before they even touch their 401k contributions. Here's why that matters to you. There's exactly one account in the entire U.S. tax system that gives you a triple tax advantage. Not your 401k, not your Roth IRA, not your brokerage account. Just one. And if you're not using it strategically, you're leaving tens of thousands of dollars on the table over your career. Possibly hundreds of thousands, depending on your timeline. Let me show you what I mean by walking through the actual mathematics, the specific strategies high net worth individuals use, and most importantly, the rule change at age 65 that transforms this medical account into something far more powerful. The numbers that matter in 2026. Before we get into strategy, you need to understand the current contribution limits because these just increased for 2026. Individual coverage. You can contribute $4,400 for 2026, up from $4,300 in 2025. Family coverage. $8,750 for 2026, up from $8,550 in 2025. Catch-up contribution if you're 55 or older, an additional $1,000, which doesn't change with inflation. Now, those might sound like modest numbers compared to a 401k, where you can defer $23,000 annually. But here's what changes the equation completely, the tax treatment. With a 401k, you get one tax benefit. Contributions reduce your taxable income today, but you pay ordinary income tax on withdrawals in retirement. That's a single tax advantage. With a Roth IRA, you also get one tax benefit. You pay tax on contributions today, but qualified withdrawals in retirement are tax-free. Again, one advantage. With an HSA, you get three simultaneously. Advantage 1. Tax-deductible contributions. Every dollar you put into an HSA reduces your taxable income dollar for dollar, just like a traditional 401k or IRA. Your HSA deposits lower your federal taxable income. If you're in the 24% federal tax bracket and you max out family coverage at $8,750, that's $2,100 in immediate federal tax savings, plus state tax savings if you live in a state with income tax. Advantage 2. Tax-free growth. HSAs can double as an investment account, with unused funds rolling over each year and growing tax-free. Every dollar of interest, dividends, and capital gains compounds without any tax drag whatsoever. This is identical to the growth treatment in a Roth IRA. Zero taxes on growth, ever. Advantage 3. Tax-free withdrawals for qualified medical expenses. HSAs are one of the few accounts with tax advantages at contribution, during growth, and during withdrawals for qualified expenses. If you use the money for medical expenses, you pay zero tax on the withdrawal. That's unprecedented. You deducted the contribution, it grew tax-free, and you withdrew it tax-free. Triple tax benefit. No other account in the tax code does this. But here's where it gets interesting for people thinking beyond just medical expenses. The age 65 rule that changes everything. Most people don't know this rule exists, and it fundamentally transforms how you should think about HSAs as part of your retirement strategy. If you withdraw money from your HSA for something other than qualified medical expenses before you turn 65, you have to pay income tax plus a 20% penalty. But after you turn 65, that 20% penalty no longer applies, and you only pay income tax. Once you're 65, your HSA is treated like a traditional IRA if you withdraw money for non-medical expenses. Read that again. After 65, you can withdraw HSA funds for any reason whatsoever without penalty. Want to use it for travel? Fine. Want to buy a car? Fine. Want to supplement your income? Completely fine. You'll pay ordinary income tax on non-medical withdrawals, just like a traditional 401k or IRA, but there's no penalty. This means an HSA functions as a medical expense account with triple tax benefits before and after 65, a traditional IRA equivalent after 65 for non-medical expenses, but with one crucial difference. Unlike those accounts, HSAs are not subject to required minimum distributions, RMDs. the yearly withdrawals the IRS requires you to take from most retirement accounts after a certain age. You're never forced to take money out. It can sit there growing tax-free indefinitely. When you need it for medical expenses, you withdraw it tax-free. When you want it for other expenses after 65, you withdraw it and pay ordinary income tax. But you control the timing completely. Now do you see why wealthy investors prioritize this? The strategy wealthy people actually use. Here's what high net worth individuals understand that most people miss entirely. You don't use your HSA to pay current medical expenses if you can avoid it. That's the opposite of the optimal strategy. The correct approach: max your HSA contributions every single year, pay medical expenses out of pocket with after-tax dollars, and let the HSA grow completely untouched for decades. Why? Because of compound growth on tax-free money. Let's run the actual numbers. Say you're 35 years old, you max out family HSA contributions at $8,750 annually, and you invest it in a low-cost S&P 500 index fund, averaging 10% annual returns. You do this for 30 years until you're 65. At 10% growth, after 30 years, you'd have approximately $1.58 million in your HSA, tax-free, ready to be withdrawn tax-free for medical expenses, or withdrawn after 65 and taxed as ordinary income for non-medical use. Exactly like a traditional 401k, but with no RMDs forcing you to take distributions. Now compare that to paying your medical bills from the HSA every year. You might spend $3,000 to $5,000 annually on healthcare. That money comes out of the account, never has the chance to compound, and you end up with maybe $200,000 to $300,000 after 30 years instead of $1.58 million. The difference? Over $1.2 million. Just from letting it compound instead of spending it immediately. But here's the sophisticated move that takes this even further. As long as the expense is eligible and was incurred after your HSA was established, you can take a distribution whenever you choose. This is called shoeboxing receipts. You pay medical expenses out of pocket. You save every single receipt. Years later, or even decades later, you can reimburse yourself tax-free from your HSA for those old medical expenses. There's no time limit. As long as the expense occurred after you opened the HSA and it was a qualified medical expense, you can withdraw that amount tax-free whenever you want. This gives you incredible flexibility. Your HSA is growing tax-free for 30 years. Meanwhile, you're accumulating receipts for tens of thousands in medical expenses. At retirement, if you need cash for any reason, you reimburse yourself tax-free for all those stored-up receipts. Free liquidity with zero tax consequences. Investment options most people don't use. Here's another thing most people don't realize. HSAs can double as an investment account, with unused funds rolling over each year and growing tax-free. Most HSA providers allow you to invest your balance in mutual funds, ETFs, or other securities once you maintain a minimum cash balance. That minimum varies by provider, typically anywhere from $1,000 to $2,500. Once you're above that threshold, you can invest the rest exactly like you would in a brokerage account. The sophisticated strategy: invest 100% of your HSA in equity index funds while you're young. You're not touching this money for decades, so you can handle volatility. As you approach retirement, you might shift to a more conservative allocation, but during your accumulation years, maximize growth potential. Why do most people do this? Because they're draining their HSA every year paying for prescriptions and doctor visits. They never build up enough balance to invest. They're using it as a checking account instead of a retirement vehicle. Wealthy individuals understand you want this money invested and compounding tax-free for as long as possible. Pay medical bills from your taxable checking account. Let the HSA grow untouched. The high-deductible plan requirement explained. Now, there is one requirement you must meet to contribute to an HSA. To contribute to an HSA, you must be enrolled in an HSA-eligible health plan. For 2026, the minimum deductible amount for HDHPs will increase to $1,700 for individual coverage and $3,400 for family coverage. The HDHP maximum amount for annual out-of-pocket expenses will rise to $8,500 for self-only coverage and to $17,000 for family coverage. So you need a health plan with at least a $1,700 deductible for individual coverage or $3,400 for family coverage. These are called high-deductible health plans, or HDHPs. Many people avoid HDHPs because they're worried about the high deductible. What if I get sick and have to pay thousands out of pocket? That's valid concern if you're living paycheck to paycheck. But if you can afford to pay medical expenses from cash flow, the HDHP makes financial sense for one simple reason. The premiums are substantially lower. A traditional PPO plan might cost $800 per month in premiums. An HDHP might cost $450 per month. That's $4,200 annual savings in premiums. You can direct that savings straight into your HSA, building your tax-free medical fund while reducing current costs. Over time, the combination of lower premiums plus HSA tax benefits plus tax-free compound growth dramatically outweighs the higher deductible in most scenarios, especially for people who are generally healthy. Why this beats a 401k for medical retirement expenses? Let's compare HSAs directly to 401k. As for funding medical expenses in retirement, because this is where the advantage becomes undeniable. According to the 2025 Fidelity Retiree Healthcare Cost Estimate, a 65-year-old individual may need $172,500 in after-tax savings to cover healthcare expenses in retirement. That's $172,500 after tax. If you're funding that from a 401k or traditional IRA, you need to withdraw more than $172,500 because those withdrawals are taxable. If you're in a 22% tax bracket in retirement, you need to withdraw approximately $221,000 from your 401k to net $172,500 after taxes. But if you funded medical expenses from an HSA, you withdraw exactly $172,500 tax-free. No tax bill. That's nearly $50,000 in tax savings on the exact same medical expenses. Plus, unlike a 401k, HSAs are not subject to required minimum distributions. Because you're not forced to take money out, your HSA can stay invested and keep growing tax-free until you choose to use it. With a 401k, you must start taking RMDs at age 73, whether you need the money or not. This creates forced taxable income that can push you into higher tax brackets and increase Medicare premiums. HSAs have no such requirement. Complete flexibility. Medicare enrollment ends HSA contributions. One critical rule you need to understand. Once you enroll in Medicare, you must stop contributing to your HSA. Contributions are only allowed while you're covered by an HSA-qualified high-deductible health plan and not enrolled in any part of Medicare. This is why maximizing contributions before Medicare becomes crucial. Most people enroll in Medicare at 65, though you can delay if you're still working and covered by an employer plan. But once Medicare Part A or Part B starts, HSA contributions stop. However, you can still use the HSA. You can use your HSA to pay certain Medicare expenses, including premiums for Part A, if applicable, Part B and Part D prescription drug coverage and Medicare Advantage. You just can't contribute new money. There's also a retroactive enrollment trap you need to know about. If you sign up for Medicare Part A after turning 65, your coverage is retroactive for up to 6 months, but not earlier than your 65th birthday. That means you'll need to stop HSA contributions 6 months before your Medicare start date to avoid accidentally over-contributing. This catches a lot of people. They think they can contribute until the day they enroll in Medicare, but the 6-month retroactive rule creates excess contributions that trigger taxes and penalties if not corrected. The real reason billionaires love this account. Let me bring this full circle by explaining why ultra-wealthy individuals prioritize HSAs even when they could easily pay medical expenses from cash flow without any tax benefit. It comes down to effective tax arbitrage. When you contribute $8,750 to an HSA and you're in the 37% federal tax bracket, plus 13.3% California state tax bracket, if you're in the highest bracket in California, you're saving 50.3% in taxes immediately. That's $4,401 in tax savings from 1 year's contribution. You invest that money. It grows tax-free for 30 years. You withdraw it tax-free for medical expenses. Or you withdraw it after 65 and pay ordinary income tax for non-medical use. But by then you might be in a lower tax bracket in retirement. The wealthy understand this is free money from tax savings that compounds into significant wealth over time. An extra $100,000, $200,000, $500,000 in tax-free medical funds that can supplement retirement income or cover the astronomical healthcare costs that inevitably come with aging. Healthcare will likely be one of your top 5 expenses in retirement. Having a dedicated, tax-advantaged account specifically for those costs provides both financial security and tax efficiency that's impossible to replicate any other way. Practical implementation starting today. So what should you actually do with this information? If you're not currently enrolled in an HDHP, run the numbers during your next open enrollment period. Compare total costs, premiums plus expected out-of-pocket expenses between your current plan and an HDHP option. Factor in the HSA tax savings. For many people, especially those who are generally healthy, the HDHP plus HSA combination saves money even if you hit the deductible. If you already have an HSA, but you're spending from it regularly, stop. Pay medical expenses out of pocket if you can afford it. Let your HSA balance build. Once you reach your provider's investment minimum, invest the balance in low-cost index funds. Your goal is maximum compound growth over decades. Start saving receipts systematically. Keep every medical receipt in a dedicated folder, digital or physical. Include the date, description of expense, and amount. These are future tax-free reimbursements you can claim whenever you need liquidity. Max contributions every year before other retirement accounts. If you're trying to prioritize retirement savings and you qualify for an HSA, max the HSA first before contributing to a traditional IRA, or even before maxing your 401k beyond the employer match. The triple tax benefit makes it mathematically superior. Understand the age 55 catch-up opportunity. Once you turn 55, you qualify for the full catch-up for the year, even if your birthday is late in the year. This is your window to accelerate contributions before Medicare enrollment ends your eligibility. If you're married and both spouses are 55 plus, you can each make catch-up contributions, but you need separate HSAs. Why most people get this wrong? The fundamental mistake most people make with HSAs is treating them as medical spending accounts instead of retirement investment vehicles. They contribute money, they spend it immediately on healthcare, and they miss the entire compounding advantage. This happens because of psychological framing. The account is called a health savings account. It's marketed for medical expenses. Employers present it as a way to pay for doctor visits with pre-tax dollars. All of that is technically true, but it obscures the real opportunity. The real opportunity is building a tax-free pile of capital that can either fund medical expenses completely tax-free or function as supplemental retirement income after 65 with no RMDs and complete withdrawal flexibility. Wealthy people understand this distinction. They view HSAs as one of the best wealth-building tools in the tax code, not as a medical checking account. They max contributions regardless of current medical expenses. They invest the balance aggressively. They pay medical bills from other sources. And decades later, they have hundreds of thousands or even millions in tax-free medical funds supporting their retirement. The difference in outcomes between these two approaches is staggering. Same account, same contribution limits, completely different results based purely on strategy. Final thoughts. Here's what you need to take away from this. HSAs offer a triple tax advantage that no other account in the U.S. tax code provides. Tax-deductible contributions, tax-free growth, tax-free withdrawals for medical expenses. After age 65, they function like a traditional IRA for non-medical withdrawals, but without required minimum distributions. The HSA contribution limits for 2026 are $4,400 for self-only coverage and $8,750 for family coverage. Those 55 and older who are not enrolled in Medicare can contribute an additional $1,000 as a catch-up contribution. The sophisticated strategy is not to spend from your HSA for current medical expenses. The sophisticated strategy is to max contributions, invest the balance in equities during your working years, pay medical expenses from taxable accounts, save all receipts for future tax-free reimbursement, and let the account compound tax-free for decades. This creates a substantial pool of tax-advantaged capital that can fund the inevitably high medical expenses of retirement completely tax-free, or supplement income after 65 for any purpose with taxation identical to a traditional IRA, but more flexibility due to no RMDs. Most people will never use this strategy. They'll continue treating HSAs as medical checking accounts, spending the money as fast as they contribute it, and missing out on potentially hundreds of thousands in tax savings and compound growth. But you now understand what the wealthy understand. You know the rules. You know the strategy. You know the numbers. The only question is whether you'll implement it. If this changed how you think about HSAs, share it with someone who needs to hear it. Drop a comment with your questions or your current HSA strategy. And make sure you're subscribed, because next time we're breaking down another tax loophole that high-income earners use systematically, but almost nobody talks about publicly. Thanks for watching.